Have you ever wondered what truly safeguards your money when you're navigating the exciting yet sometimes volatile world of cryptocurrency? We hear a lot about innovation, decentralized finance, and the future of money, but what about the bedrock of financial security that traditional banks offer? I'm talking about things like FDIC and SIPC insurance. These acronyms are synonymous with peace of mind in conventional finance, but do they translate to the crypto space? And more specifically, what kind of protection does a platform like Gemini, one of the leading names in crypto, actually provide its users? It's a critical question, and frankly, it's one that often gets overlooked in the hype surrounding digital assets. For years, the crypto market has been characterized by its Wild West reputation, a place where fortunes could be made or lost in the blink of an eye, and where regulatory frameworks were, to put it mildly, evolving. This lack of clear, consistent consumer protection was a significant barrier for many who were otherwise interested in exploring the potential of cryptocurrencies. They wanted the innovation, but they also craved the security they were accustomed to with their traditional bank accounts and investment portfolios. Then came platforms like Gemini, founded by the Winklevoss twins, who from the outset emphasized regulation, compliance, and security. Their vision was to build a bridge between the burgeoning world of digital assets and the established financial system, complete with the kind of robust protections that inspire confidence. But what exactly does that mean in practice? When you deposit your hard-earned money, whether it's US dollars or digital assets, onto a platform like Gemini, what mechanisms are in place to ensure its safety? Are you really getting the same level of protection you'd expect from a traditional bank or brokerage? To answer that, we need to understand the fundamental differences between fiat currency and cryptocurrencies, and how these differences impact the applicability of traditional insurance schemes like FDIC and SIPC. We'll break down what each of these insurances covers, why they exist, and then dive deep into Gemini's specific approach to asset protection, which includes a blend of traditional insurance where applicable, and innovative, bespoke solutions designed for the unique challenges of the crypto landscape. Let's start with FDIC, the Federal Deposit Insurance Corporation. This is the gold standard for bank deposits in the United States. If you have a checking account, a savings account, a money market account, or a certificate of deposit at an FDIC-insured bank, your funds are protected up to $250,000 per depositor, per insured bank, for each account ownership category, in the event of a bank failure. The key here is bank failure. FDIC insurance isn't there to protect you from losing money if your investments go south or if you fall victim to a scam. It's specifically about protecting your cash deposits if the bank itself collapses. It's a critical safety net that has been instrumental in maintaining public confidence in the banking system for decades. Now, where does Gemini fit into this? Gemini is not a traditional bank, but a cryptocurrency exchange and custodian. However, when you deposit US dollars into your Gemini account, those funds are held in custodial accounts at regulated banks. Because of this, your US dollar deposits in your Gemini account may be eligible for pass-through FDIC insurance. This means that while Gemini itself isn't an FDIC-insured bank, the underlying banks where your fiat currency is held are. Therefore, if one of those underlying banks were to fail, your US dollar balance, up to the $250,000 limit, would be protected by the FDIC. This is a crucial point, as it provides a direct link to a familiar and trusted form of consumer protection for your fiat holdings. But what about your cryptocurrencies? This is where things get a bit more nuanced. Cryptocurrencies are not considered deposits in the same way traditional fiat currency is. They are digital assets, and as such, they are not covered by FDIC insurance. This is a fundamental distinction. Just as your stock portfolio isn't FDIC insured, your Bitcoin or Ethereum holdings aren't either. This leads us to SIPC, the Securities Investor Protection Corporation. SIPC protection is designed for customers of brokerage firms. It safeguards against the loss of cash and securities, like stocks and bonds, held by a customer at a financially troubled SIPC member brokerage firm. The limit of SIPC protection is $500,000, which includes a $250,000 limit for cash. Importantly, SIPC protects against the loss of securities due to the brokerage firm's failure, not against market losses. If your stocks drop in value, SIPC won't cover that. It's about ensuring you get your assets back if the brokerage goes bankrupt and your assets are missing from your account. So, is Gemini SIPC insured? No, Gemini is not a member of SIPC, and therefore, your cryptocurrency holdings are not covered by SIPC insurance. This is because cryptocurrencies are generally not classified as securities in the same way stocks and bonds are by SIPC. This distinction is vital for understanding the scope of protection available. Given that neither FDIC nor SIPC directly cover cryptocurrency holdings, how does Gemini address the security of your digital assets? This is where Gemini's commitment to robust security and specialized insurance really shines. They understand that while traditional frameworks don't apply, the need for asset protection remains paramount. Gemini employs a multi-layered approach to secure your digital assets. A significant portion of the cryptocurrencies they hold on behalf of their customers are stored in cold storage. This means the digital assets are held offline and hardware devices that are not connected to the internet. This drastically reduces the risk of online hacks or cyber attacks. Think of it like putting your most valuable possessions in a secure, off-site vault rather than keeping them in an easily accessible safe in your home. These cold storage systems are further protected by multi-party technology, role-based governance protocols, multiple layers of biometric access controls, and stringent physical security measures at geographically distributed facilities. The private keys, which are essential for accessing and moving cryptocurrencies, are never connected to the internet. This uncompromisingly offline approach is a cornerstone of their security strategy. For assets that need to be readily available for trading, Gemini uses hot wallets. These are online wallets that allow for quick transactions. While more susceptible to online threats than cold storage, Gemini maintains substantial insurance coverage for the crypto assets held in their online hot wallet. This insurance is specifically designed to protect against certain types of losses, such as those resulting from cybersecurity breaches or fraudulent transfers due to a compromise of Gemini's systems. As of recent information, Gemini maintains a significant amount of digital asset insurance for certain types of losses, including coverage for both their hot wallet and cold storage. This insurance is a critical layer of protection for your digital assets, offering a safety net against specific risks that are inherent to holding cryptocurrencies on an exchange. With that said, thanks for watching, and until next time.